Okay, so we're going to go over the review sheet that I put up on Moodle. I have one review sheet that has all of the information that I want you to know. So just some terms, definitions, just to be familiar with all of this information, because I'm going to pull some questions from these, from all of this that's on here. So the assets, I have some examples of assets, know what type of accounts are assets, liabilities, or an equity. I could have a question on there that says identify what type of account is for these specific accounts that I have listed. And so I'll list all the different ones. If I put cash, then you would select asset or write in asset A. It'll be something like that. Know your principles. I'll have some matching. Also know the 3 different types of businesses: the sole proprietorship, partnership, limited liability company. Also the corporations, what we've been learning about. So I don't see that one listed on here. I'll have to add that. So I'll have to modify it. If you go to the chapter 1 notes, I believe this is on there. I think that's where I pulled it from, was the note sheet. External, internal users. Again, I could give you just a list of the type of users and ask if they're internal, external. Know what accounts show up on those financial statements. I'll have some questions in regards to that. All your formulas. This one's the return on assets, but there's a bunch of other ones that we did at the end of the chapters. We've got the debt ratio, current ratio, asset test, gross margin ratio. Know how to do those, because I'll put a problem on there that you'll have to know how to use the information to give me an answer. Okay. Know the ledger, general ledger, chart of accounts, trial balance. Know that the trial balance is just a list of all those accounts with their balances. And remember, in chapter 3, we talked about adjusting entries. You want to know that the trial balance that you run before those adjustments is just the trial balance. And then you'll make your adjusting entries. And then we run something called an adjusted trial balance. And so just know the difference, that there's 2 different trial balances. One's before the adjustment, one's after the adjustment. T account. I want you to know how to set up a T account, that the left side is your debit, your right side is your credit on the T account, and how to look at some different adjustments and put those numbers into the T account. I think I had an example on the practice. The last problem, I believe, has some T accounts for you to put that in there and then take those and bring them over to a trial balance. So I want you to be familiar with how to do those. Know what accounts are temporary. This is for when you're doing your closing entry at the end of a period. So we talked about, if the period is a calendar year, at the end of that year, you want to close all your temporary accounts to the income summary, and that will clear out everything to 0. So when you go into your new period, you're starting over. That's all your expenses and your revenue accounts, your dividend account, all that's going to close out to be 0. It's going to flow through the income summary account, and then it's going to go into retained earnings. I want you to know not necessarily how to do the entries for the test, but understand what the temporary accounts are. Which ones would be the ones that would close through the closing process? What type of accounts? It's the revenue, expense, and dividend. And we talked about, in this class, we're doing accrual accounting based on GAAP. And also we talked about the cash basis accounting. So cash basis is you record it as revenue when you receive cash, no matter if you've done the service or not. And anything that you spend, you count that as an expense, any money going out. So in the accrual basis, if we prepay an insurance policy, we're putting that to prepaid insurance and we're going to expense it over a period of time. For the cash basis, we wouldn't do that. We would say, okay, we spent $12,000 on insurance this year, and that's my expense. So I just want you to know the difference between cash and accrual basis. If I ask a question and I give you some numbers, whether it be just revenue numbers or how much had been collected versus how much was on credit, I need you to know, like, if I say, can you tell me the cash basis, how much revenue would be, or how much the expense would be, or what is the net income based on cash? You would look at the question, and if I said cash basis, you would be looking to see how much money came in and how much money went out. The difference between the two is your net income. If it's accrual that I'm looking for using the accrual basis, then you're looking to see what actually was earned for revenue, not so much, okay, if I said revenue earned is 50,000, cash received is 60,000. Well, for cash basis, your revenue would be 60,000. For the accrual basis, your revenue would only be 50,000. So I want you to be able to pick up on that and tell me which one's cash, you know, how much the cash net income would be or the accrual. No, the FOB, shipping point and destination, which one will the cost of the shipping be added to the cost of the inventory? So the question would just say, okay, here's how much the product was. This is how much the shipping was. And it'll tell you if it was shipping point or FOB destination. And you'll have to know if it's shipping point, that it's the buyer that's picking up the cost of the shipping, because it transfers ownership at the time that it's shipped from its shipping point. FOB destination doesn't transfer until it hits the destination. So the person sending the product, the seller, is the one that picks up the cost. So know the difference so that you know if you have to bring that in as part of your inventory. Okay, so the practice problems, I'm going to scoot this over and go to the blank so we can work through those. All right, so if you have any questions, just stop me as we're going through it. So we have the company paid $2,100 cash for an insurance policy paid on January 15th, covering 24 months. The benefit period begins on February 15th. Prepare a journal entry to record the payment on January 15th. Now, this doesn't tell you anything about this organization calculating based on cash basis. So if it doesn't specifically say anything about cash basis, I want you to always assume it's accrual basis of accounting, and that's how we're going to do our journal entries. If I paid out cash of $2,100 for a policy that's covering 24 months, and it begins in February, I've paid for something that I'm going to receive benefit for in the future. I haven't used it yet, so there's no expense yet. So when I make the payment on January 15th, I want to write out my journal entry. If I ask you to write it out, let's see if I have tools here. Hang on. If I ask you to write it out, you would write just like I'm doing. It could possibly be a multiple choice where I've given you 4 different journal entries and you have to choose the right one. It could be either or. So on this one, we'll say 115. We're paying out for an insurance policy. We're prepaying it. So it's a prepaid insurance for $2,100. That's my debit. And then I'm going to credit my cash because I'm spending the money now for $2,100. Okay, so I have my date. My debit is first. The credit is second, and it's indented in to identify that it's a credit. And I have 2 different columns here. This being my debit column, this being my credit column. So that's the format that I want you to use when you fill in the journal entry. Okay, so if we have a merchandise that's being returned to the seller. We talked about contra asset accounts. We talked about contra asset accounts and contra revenue accounts. We talked about two different ones. This particular one, we're talking about merchandise that was being sold, and that's being returned. So that's on my sales end. So the contra account for this particular account is your sales returns and allowances. This is the account that we'll use if you have a journal entry that you need to do as part of the test of something that's being returned. This is the account we would use. We wouldn't go back to sales in that same account. We would go to the contra revenue account, which is sales returns and allowances. So the other one that we talked about was the contra asset account. That's for depreciation. And you use that when you're setting up accumulated depreciation. All right, so next, Beach Company reported total revenue of $225,000 from May 2019, net income of $55,000 on their income statement. What is the total expense? Well, if you know that we have revenue minus expenses, this is for a service company. If we have revenue and expenses only, we're dealing with a service company. We don't have inventory, because if we had inventory and we're selling that, we would have cost of goods sold, and there would be another layer in there. But for this one, it's just revenue, expense, and income. So when you look at it, it's revenue minus expense equals net income. And so now we just have to fill in the formula, do the math. So we're going to say 225 less the 55,000, and the difference here, this is going to give me what my expenses were. Okay. So my answer is 170,000. And you don't have to write out revenue minus expense equals net income. You can just do the math and give me the number. Summer Fund has total equity at the beginning of the year of 22,200. There's no new stock issuances during the year. The company has net income of 15,500 and pays dividend of 3,000. What's the ending equity balance? Okay, so we talked about how to calculate retained earnings. We have to take the beginning retained earning balance, add net income, less dividends, and that equals the ending balance for retained earnings. Okay, so we're going to look to see what numbers we have and plug those in. So beginning equity balance, the beginning, then we add the net income to it. So the beginning retained earnings plus the net income less the dividends equals my ending equity or my ending retained earnings. Okay, so we're going to take beginning of the year was 22,200. It has net income of 15,500, and I pay out dividends of 3,000. So I'm just plugging those numbers into the formula to come up with my answer of 34,500. Okay, so that's that retained earnings formula that we talked about. Take the beginning balance plus net income less the dividends, and that gives you your ending equity, your ending retained earning. Maybe I give you, could be exactly like this. Let's say I didn't give you the net income, but I gave you the ending equity. You should be able to take the ending number and back into what this number would be here. Okay, so once you have the formula, you can maneuver it around to solve the problem. All right, Cordell Shoes has sales of 5,500. Cost of goods sold 3,200 and operating expenses of 1,050. Okay, so we know that this is a company selling merchandise because we have cost of goods sold. And cost of goods sold, remember, we break it out into two sections. We have our revenue or our sales less the cost of goods to come up with the gross profit. Then we subtract the operating expenses to come up with the net income. So we have sales less cost of goods. That gives me my gross profit. Then I deduct my expenses. to come up with my net income. So there's two pieces here. You may get asked both, or maybe I only ask for one. So remember how to calculate that. So if I just say, what is the gross profit? You wouldn't need the expenses to give me that number. You would only use your sales less your cost of goods sold, and you would give me the gross profit. If I ask for the net income only, then you would just go ahead and calculate it out using both cost of goods and expenses, deduct it from your sales in order to give me that number. So for gross profit, you take the 5,500 less the 3,200. So that's my answer. If it's net income, then I'm taking my gross profit less my expenses to come up with my net income. Okay, so I might ask both just like this, or I may only ask for the net income, or I might only ask for gross profit. So just keep in mind this formula here so you know how to calculate it and what numbers you need. Sometimes you have more numbers than you need that's in the problem. Don't try to use them all. The company pays their employees $10,500 on February 6th for a period of 10 days. 5 days were worked in January. What is the adjusting entry for January? So I'm telling you that the employee is going to be paid in February. So we haven't paid it yet. So if I want to set up an adjusting entry in January, I'm not going to use cash because I'm not paying them in cash, not yet. I'm not paying them until February. So on January 31, I want to recognize the expense portion that belongs to January. So I'm saying that 5 days, so it's half because they work 10 days, and I want to know what the expense is for 5 of those days. So we're going to have salary expense. And I'm realizing right now the answer sheet is incorrect. So you need to make a correction to that. I used the whole number when I put the answer on there for you. You have to take the 10.5 and divide that by 2 because it's only half. You only worked 5 days. Okay, so it's 52.5. And then I'm doing salaries payable because I haven't paid it out yet. No cash is being sent out yet. This is my January entry to recognize the January portion of the expense. I need to make a note here. Hang on one second. I'm making a correction to the sheet so I can post up the adjusted one, and I'll send an email. All right, so what I did was just took the 10.5. Now I'm going to divide it by the whole, number of days, and then I'm going to multiply it by the number of days worked. So 10.5 is for 10 days. That's why I'm dividing it by the 10 first to come up with what it is per day. Once I have my per day, then I can calculate out how many days do I need. In this example, we need 5 days for January. And that's how I came up with the 52.5, 52.50. Okay. I'm glad I was checking the answer sheet. Let me know if you see any other errors, please. Okay, so on number 7, the company paid $240,000 on January 1 for an insurance policy that benefited 24 months. So what is the monthly payment? So I'm not looking for the journal entry. I just want you to tell me how much is this adjusting entry going to be each month. So I'm paying the policy $240,000 divided by 24 months is $10,000 per month. Okay, so that's how I calculate it out. Then the adjusting entry, I'm looking for just 1 quarter. I could change that and say I want to know what it is at the year end, which means you would give me a whole year. Instead of just 3 months, you would give me 12 months. In this particular example, I'm looking for 3 months. I'm doing an adjusting entry for the first quarter. I want to recognize a portion of that expense in the first quarter. So I paid for it for January. My policy is good for 24 months. So I know the next 2 years, I'm going to have to do $10,000 per month for my insurance expense. So for 3 months, I'm just taking that 10,000, multiplying it by 3 to come up with the 30,000. Okay, so when I do my entry, it's going to be the end of the 3 months. So it's going to be the 3/31 date. Let me see what this problem is. And then I'm going to do an entry for insurance expense. That's my debit for 30,000. I'm going to credit that prepaid insurance for 30,000. Okay, so I have my date of 3/31, end of the quarter. I'm recognizing my expense of 30,000, and then I'm crediting insurance, prepaid insurance for 30,000. So when we bought the policy on January 1, when we paid for it on January 1, our entry would have been to put it to prepaid insurance for 240,000, and then we would have had a credit to cash for 240. Okay, so that would have been the entry when we purchased it. I didn't ask for that entry, but that's what we had done in the previous example. So on January 1, when I put this policy on the books, it's sitting in prepaid insurance. So that's why this adjusting entry, I'm crediting prepaid insurance because I've already paid for it. That entry's already been done. I'm not looking for you to give me that. I'm looking for what the adjustment would be to recognize expense for the first quarter. Do you have any questions on that? Okay. Number 8. Let's see. All right. Summer fund purchase equipment of $15,000 has a useful life of 5 years. The salvage value is $5,000. What's the yearly depreciation expense? So remember, whenever we're trying to figure out the depreciation for this current time, we're only doing straight line depreciation is what it's called, straight line. And you'll learn some other methods, but that's what we're using for right now, straight line. In that formula, we have to take the cost of the asset less the salvage value divided by the useful life. Okay, so what did I pay for it? What's my cost? $15,000. What's the salvage value? 5. And then my useful life is 5 years. So I have 10,000 divided by the 5 to come up with the 2,000. That's how much it is per year. On January 5th, the company purchased 30,000 of inventory on account, 3% 15 net 45. So remember, that means if I pay it within 15 days, I get that 3% discount. Otherwise, I have to pay it in 45 days and I pay the full amount. The company pays for the inventory within the discount terms. They pay it on January 10th. Okay, so I might ask both of these, or I might just ask one part of it. What is the journal entry when we purchase the inventory? So what would my entry be when I buy the inventory on credit? I'm not spending cash yet. I'm buying it on account. I have to bring my inventory in. I'm adding to my shelf. My inventory is an asset account. So I'm going to debit inventory. So this is going to be dated January. Let me just put 1/5. Okay, so I'm going to go inventory or merchandising inventory for 30,000. And then I have accounts payable for the full amount. I'm going to set it up for the whole amount, 30,000. I'm not going to list it having a discount, not yet, unless I pay it within terms. So when I purchase it, I have to set up the entire amount as a liability that I owe. Now, when I make the payment, I'm making the payment on January 10th. It's within the terms. That means I get to take the discount. So I need to calculate what my discount is. So I can do 30,000 times 3% to come up with what my discount is. Okay, so discount is going to be $900. So when I make my payment, I'm not paying the whole 30,000. I'm going to pay the 30,000 less than 900. Okay. So my entry, I need to do what? I have to clear my accounts receivable first. And I want to clear it not for the difference, but I want to clear it for the full amount of the accounts payable. So I need to wipe this out completely. So I'm a debit accounts payable to remove it off my books so that I no longer show that I owe them any money. So there's my 30,000, that clears that off. Now I'm spending cash. I'm not giving them the full amount. I'm only giving them the 30,000 less the 900, which is the 29,100. So cash going out is 29,100. And then I have this discount of $900. We're going to go ahead and credit inventory to reduce the cost of the inventory by that amount. Now you could keep it in a separate account, a discount account, but for now, for purposes of the test, I want you to just reduce inventory by that amount, whatever the discount is. Okay, so now our journal entry is in balance. We have 30,000 debit and we also have 30,000 credit. Okay, so the cash going out is less the discount. The discount is going to go to inventory as a credit so that it reduces the amount of money sitting in the inventory account. It's reducing the cost of that. All right, number 10. The company received $30,000 on April 15th for consulting services that will be provided on June 30th. What is the journal entry when we receive the cash? So we're being paid for something that we haven't done yet. That's the unearned revenue. Remember, when we have unearned revenue, that means that we are liable to have to provide a service in the future or provide products in the future. We haven't done it yet. We're receiving the money in advance. Well, when we receive the cash, we have to put it into our bank account. So on 4/15, it wants to know the journal entry when I receive it. So I'm receiving cash. I need to put that in my cash account so that way when I do my bank reconciliation, it balances because I have the money. But I don't want to record the revenue just yet because I haven't provided the service. So it's going to be unearned revenue, consulting services, or whatever the account is called. We just need to put it as unearned revenue. And that's for the full 30,000 because we haven't provided anything yet. Okay, then I said, what is the adjusting entry in June when the services are earned? So now June comes, we've provided all the services during June. So on June 30, we've provided those services in full. So on June 30, I'm gonna do an adjusting entry. Does it involve cash? Because I'm not receiving the cash. I already received it in April. All I need to do is recognize that I now have a revenue I have to put on the books for those consulting services. So I'm not going to owe that service any longer. So it's the same thing like with payables. I want to remove unearned revenue in full because I've completed the services. There's no longer a liability on the books. So I'm going to remove that in full. So unearned revenue, debit 30,000. Okay, and what am I crediting? I'm going to credit a revenue account or consulting services revenue, or revenue is fine, but we're providing consulting service revenue. I want to know that you know that this is a revenue account for 30,000. So now I provided the service. Now I can put the sale on my book, and that goes towards my net income. Okay, because it's going to flow into the income statement because that's a revenue account. Whereas before it's sitting as a liability, it's on my balance sheet as an unearned revenue. I'm providing that in the future. So now that I've actually done the service, I can record it as income. Now, I could have said here that, and I could have asked for May. So maybe in May, let's say we provided half the service in May. In that case, you wouldn't be clearing off the liability in full. If the question says, that in May, I fulfilled 15,000 of the unearned revenue, what would the entry be for the May adjustment? Then that's a little bit different. I wouldn't clear the unearned revenue in full because I've only provided 15,000 worth of services. So if that was the case on May 31, I would do unearned revenue for 15,000, and I would put it to my revenue account for 15,000. So I'd only want to show half in May, and then maybe in June I did the other half and I cleared it all out by June 30th. But some of the services were provided in May, so that could be a little bit of a different type of question asked. Same thing, but you would just have to pay attention to how much is actually being used for like the services that were provided in that month. It may not say in full. It may only say, you know, half or however much. It may give you a dollar amount. Just know that you have to clear that unearned revenue and recognize revenue as a credit for whatever amount that it's given to you. Okay, summer fund sold inventory on February 1 for $2,000 on account with credit terms, 2% 10, net 30. The inventory had a cost of $900 when purchased. On February 3rd, the customer returned product with a sale price of $500 and a cost of $380. The customer paid for the product on February 9th. Okay, I'm giving you 3 parts here. I may not ask all the parts. I may only ask for one part. I may not ask A, B, and C. Maybe I just ask B. Okay, so let's walk through all of them so you know how to work the whole problem out, so you know how to do the portion that's being asked. Okay, so summer fund sold inventory on February 1 for $2,000. So remember that we have a sale of merchandise and it has 2 parts. So you're going to have 2 journal entries. So you're going to have 2 debits and 2 credits, right? We're going to look at the sale part of it. And then we also have to look at the inventory cost side of it. Okay, so when we have the sale on February 1, they are purchasing on credit terms. So we haven't received cash. We're selling it to them, and that is called accounts receivable. I'm setting this customer up to have a receivable that we're going to receive money in the future. I don't know if they're going to pay within terms yet. I only know they have the opportunity to take a credit of 2%. Don't know if they're going to take advantage of that. So I'm going to set the receivable up for the full amount. So I have accounts receivable for $2,000. I have sales or revenue for $2,000. And then I have my cost side. So I have cost of goods sold. How much was the cost of the inventory? I'm telling you the full amount right here. Cost was, the inventory had a cost of $900 when it was purchased. So that's my cost, $900. And then my offset to that is I sold them inventory. So I have to reduce my inventory by the $900. So that would be my entry to record the sale. So I'm removing my inventory, recognize the cost, and then I'm also setting up the receivable so that I know that I'm going to have that money coming to me in the future. And I've recognized my sale. Okay, so I have my sales and my cost. The difference between those is my gross profit. All right, now I have a journal entry to record when they made a return. So it's telling me the customer returned product with a sale price of $500 and a cost of $380. Again, we're going to have 2 parts because I have the part that's affecting my sales and that tenant, that customer account. And then I also have the cost. My inventory is coming back in and I need to know what is the cost of that inventory. So I have to have both. All right, so let's look at the sales side of it first. So what is the contra revenue account for sales? When we have returns, it's sales, returns, and allowances. So on February 3rd, the return is going to be sales, return, and allowances. How much is being returned? The sale price is what we need, $500. How much am I reducing this accounts receivable by? Well, they're no longer going to owe me 2,000. They've given me inventory worth 500. So I have to reduce that. Accounts receivable, 500. This is going to show a net now that this guy owes me $1,500, right? Okay, now my inventory is coming back in. It's telling me the cost is $380. So I have inventory coming back in for $380. And I need to credit my cost of goods sold for $380 because now my cost no longer is $900 because I brought some of that inventory back. So now it's going to be, you know, the $900 less the $380 for that particular sale. Okay. Now, what's the entry when the customer makes a payment on February 9th? So they're paying within the 10 days. So I need to calculate that out. Well, I had $2,000 that I sold him. He brought back $500. So now the customer only owes $1,500. So if he's paying me within the discount terms, he gets to take that 2%. So I'm going to multiply the 1,500 times the 2% in order to come up with how much cash am I going to be receiving. So his discount is $30. 1,500 times the 2% is $30. Okay. When I receive the cash on February 9th, how much am I receiving? I'm receiving $1,500 less that $30, which is $1,470. Right? That's the cash coming in. So I have to debit cash. I know that part of it. What is my account that I use if I've given a sales discount? We're going to use sales discount is what we're going to use to do the debit for that. It's going to be $30. Okay. Now remember that net sales formula we did, this comes into play. You know, you have the sales returns and allowances and you have sales discounts to come up with your net sales. So you have to take those into consideration when you're coming up with what your whole revenue was. Okay, so we have cash of $1,470, sales discount of $30, and we have to clear the customer's receivable because now he doesn't owe us any longer, and it's only for $1,500. So remember, we had the accounts receivable. Let's just do a little T account. So on this first part here, we had $2,000 going in, right? Then he returns product of $500. So we reduce it by 500. So now his balance is $1,500. And when I come through with this entry, when he pays, I need to clear the entire amount, not the amount of $1,470, because his account won't clear to zero. We need it to clear to zero because he's paid in full. So now I'm going to put my entry in for $1,500. This accounts receivable goes to zero. And so now we have the, the account cleared off. And we also have our inventory correct because we sold the inventory, which went out. Right here, we return it back in. So we have our inventory coming back in for the cost of just that inventory that was returned. So the difference is what our inventory is that we still have left over. We've fixed our cost of goods because we originally had 900. Now we're offsetting that. So it's going down because we don't have as much cost sold because they returned some of the product. Okay, so I don't know that you're going to have to do all three parts, but I wanted you to practice all three parts because I could ask you any part of that and you'd have to know how to calculate it. Okay, number 12, the company had the following. We had beginning inventory of 20,000, purchases of 15,000. We had cost of goods sold of 22,000. So what is my ending inventory? So remember we said we have beginning inventory plus purchases gives me what's available, right? So I have some product on my shelf. I buy some more and add to it, and that's what I have available to sell. Now I need to know what's my ending inventory. Well, during the course of the time of the period, I've sold some product. So I have to subtract my cost of goods sold. What did I sell? And that leaves me with my ending inventory. So that's the formula that you have to remember, because you may not have it listed out like this. It may be that you don't have purchases and you got to back into it. This, we had done some examples in chapter 4 for homework that had several different ones on the chart that you had to complete to figure out how to do the numbers. That would be a good exercise to practice, is that homework. So we have $20,000 in inventory. We add our purchases of $15,000. So if I asked you what's available, the answer would be $35,000. Because I'm taking my beginning inventory and I'm adding my purchases. That's what's available. We're asking what's in ending inventory. So I need to deduct what I sold from what was available in order to come up with that ending inventory. So all I have to do is minus out the 22,000. So I take the 35,000 less the 22,000 cost of goods sold to come up with my answer. So 13,000. So the answer will be 13. Okay. Number 13. So we're going to fill in the missing number. All this is your formula: assets equal liabilities plus equity. So if we have assets of 25,000, it has to equal what's on this side. I already know my liabilities is 10,000. So the difference between the 25 and the 10 is my equity, right? Just taking 25 less the 10. So 15,000. So it's just this formula right here: assets equal liabilities plus equity. Okay, here's an example of a T account. So we have to record the following transactions. It's telling me what my beginning balance is for cash and my beginning balance for inventory. So I have to know, is the beginning balance a debit or a credit? Well, I have to know what kind of account it is in order to know what the normal balance would be, right? So cash is an asset which has a normal balance of a debit. So I have 110,000 in cash as my beginning balance. Inventory is also an asset account. So I start with 52,000 on this side. Okay, so I have A, summer fund sold inventory in a cash sale for 15,000. The cost was 10,000. So it's telling me that I had a cash sale of 15,000. So I know that I received cash. So I'm not looking for journal entry. I'm not looking for you to tell me what's both sides of this with the sale and the inventory and all that stuff. You don't have to get into that. I only want to know what's happening with cash and what's happening with inventory. So in this particular example, it's telling that they gave me cash for this sale of 15,000. So I know I'm receiving cash. When cash is increasing, it's an asset. So it's going to be a debit, 15,000. I'm also trying to figure out what's happening in inventory. Well, it's saying that I sold product. I sold inventory, $10,000, right? If it's going, leaving out the assets being reduced, it's decreasing. So I have to do a credit for the 10,000. Okay. B says collected 4,500 from a customer that had an account with us. I'm collecting 4,500, which means cash is coming in. So I have 4,500 of cash coming in for B. Now, does it tell me anything about the inventory? No, nothing. Nothing's being returned. Nothing's happening with inventory. So I wouldn't have anything affecting that account. It's only the cash because I have money coming in. I'm not keeping track of accounts receivable. I'm only looking for cash. Okay, C. I purchased inventory from a vendor on account, $9,500. Well, it's telling me that I purchased it, but I didn't pay for it with cash. I'm putting it on an account, so nothing's happening to my cash. I didn't pay for it yet. It's saying that it's on account. So is it affecting inventory? Yes, because I'm buying inventory. So what's happening? I'm going to have a debit to inventory because I have an asset coming in. My products are coming in. It's an asset account. So I'm going to debit $9,500. D says paid vendor $20,000 cash from inventory order last month. Okay, so now I've already made the purchase of the product and now I have to pay for it. So I'm paying $20,000. That's cash going out. So I'm going to have a credit to cash for $20,000. Nothing's happening with inventory because I already purchased it last month and set that up. So I don't have to do anything for inventory. So for my cash, I had a beginning balance of 110. And then I'm going to add $15,000 that we received. I'm going to add the 4,500 that we received. And I'm going to deduct the 20,000 that we paid out to come up with my balance. My balance is going to be a debit. So it's 109.5, and I want it to be on the debit side. Inventory, we had a beginning balance of 52,000. And then we sold 10,000. So I need to deduct 10,000 from that. And then we purchased 9,500. So I'm going to add 9,500. Come up with my ending balance of 51.5. It's a debit. I'm going to have it on the debit side. And that's it. So we're not looking at both sides of the entry, looking for a journal entry. We're just trying to figure out what's happening in these two specific accounts. Maybe I'll just say cash. What's going on in cash? So you're going to go through these little criteria of what's happening during the course of business to figure out what transactions are affecting my cash. And that's all you're going to look for. So it's just going through these different adjustments and figuring out what's happening in this one account. You had a homework assignment where you had to identify both sides of what was happening in all those different little adjustments that you had to do, and you had to put those into the T accounts. We won't have time to do a lot of that, but I may give you one similar to this and ask for the balance in one of the accounts. So I want you to be able to go through and pick out what's happening in that account. Okay, number 15. A company had net sales of 545,000. Cost of goods sold 345,000. Its gross margin equals 890,000. Is this true or false? So we know sales minus cost of goods sold gives us our gross profit, right? So if I took 545,000 of sales and I deduct my cost of goods sold of 340,000, what's the answer? So I have 545 less the 345, that gives me 200,000. This is what my gross profit would be. So is it 890,000? No, that's false. So this, again, you'll have to know how to do the formula in order to see if the question's true or false. Okay, so instead of making you calculate it out, I may give you something like this. Cushman Company had 800,000 in sales, sales discount of 12,000, sales returns and allowances of 18,000, cost of goods sold 380,000, and 275,000 in operating expenses. It's asking for net income. So we will need all of those numbers if I'm looking for net income. So let's figure out what my net sales is first, right? Because what if I asked you for net sales on this and gave you all those numbers? So we have sales of 800,000. We have sales discount. So we're going to deduct it, 12,000. And then we have the returns and allowances. So sales returns and allowances, we're going to deduct 18,000 to come up with net sales. So we have 800,000 less the 12,000 less the 18,000, 770,000 is my net sales. Okay, so if I said, what is net sales? You're just looking at those numbers that are coming in from sales. Remember to deduct the discounts and returns. Okay, so now I have sales. If I asked you for what's the gross profit, well, then I have to deduct my cost of goods sold, because net sales minus cost of goods sold gives me gross profit. So I have the 770 less my cost of goods sold of 380,000. That's 390. So if I asked for this, that would be your number. Now, I want to go a step further because I'm looking for net income. So I need to deduct my operating expenses of 275. So once I deduct my 275, I have my net income, 115,000. Okay, so I'm taking my net sales less my cost of goods sold, less my operating expenses, and that gives me my net income. Again, know these formulas so that if I said what is net sales, you can come up with that. If I said what's gross profit, you can give me that number instead of the net income. Number 17. On December 1, office supplies account had a 359 debit beginning balance. A physical inventory count of the supplies showed 105 of unused supplies available on December 31. What's the required journal entry? So going into December, we had supplies on the shelf of $359. And it's giving me what's left on the shelf. It's telling me unused. So I know when I went to my supplies and did a count, I have about $105 left sitting on the shelf. So in order for me to figure out what was used, I just take the difference. Okay, and that's what I use. So what is my adjusting entry? I want to expense what was used. So on 12/31, I'm going to have supplies expense for what was used, the 254, right? We still have 105 left unused on the shelf. So I don't want to use that number. And I need to reduce my supplies, which is my asset, by 254. Okay, do y'all have any questions yet before we go into the last one? Now I use this one because it's a little bit more practice doing the T account, and this one you'll have to put your adjustment, all your accounts are on there. So you would have to put those amounts in on each one. So we're going to go through the different ones and put together the trial balance. Okay, Mary Sunny began business as Sunny Law Firm on November 1. Record the following November transactions by making entries directly to the T accounts provided, then prepare a trial balance as of November 30th. So all we're going to do is go through these different little scenarios, and we're going to put in those amounts in the accounts, and then we're going to come up with a balance in each one of them, and then we'll bring them over to a trial balance. Okay, so we have Mary invested $15,000 cash in a law library valued at $6,000 in exchange for common stock. Okay, so we have $15,000 in cash coming in. So I have to put my 15,000. It's an asset coming in, so it's a debit. I'm also getting a law library that's valued at $6,000. So these are two things that Mary's investing: cash in the library. So I have the law library, also an asset. So it's a debit for $6,000. And then I have common stock that's in exchange for that. So I have to make sure that Mary is recognized for giving me both of these assets. So I have to put that on the books under the common stock. So it'll be $21,000 total that she's given us. She gave us $15,000 in cash and $6,000 for a law library. So the total in exchange is $21,000. All right, B, purchase $7,500 of office equipment from John Box on credit. So I'm buying equipment, not paying cash out for it. I'm buying it on credit. The equipment is an asset, so I debit $7,500. I'm buying it on credit, which means I have to pay it in the future. It's a liability. A liability normally carries the credit balance, so I'm going to have $7,500 on my liability accounts payable. It's increasing accounts payable, so I have to do a credit. C says completed legal work for a client and received $1,500 in cash in full payment. So I have $1,500 cash coming in, debit cash $1,500. I provided service for them. I completed some legal work. So I've earned those fees. So this account's called legal fees earned, and it's a credit because that's revenue. And increasing revenue, you have to do a credit. D, paid John Bronx $3,500 cash in partial settlement of the amount owed. So I'm paying him cash $3,500. I'm decreasing my cash by $3,500. Okay, and then I have an accounts payable that I owe him $7,500. Well, I want to reduce that. So I have to reduce part of my liability by the amount that I paid. So it's going to be $3,500 as a debit. So I can reduce my payable to him and show just the difference that I owe. E, completed $4,000 of legal work for a client on credit. So I'm doing work for someone. They haven't paid me cash. They haven't paid me cash yet. It's on account. That's called what? They owe me money that I'm going to receive in the future. So it's accounts receivable. That's an asset account. So a $4,000 asset. Accounts receivable asset account. I'm debiting. And I did legal work. So now I have fees that I've earned again, $4,000. F, the firm paid $2,000 cash in dividends. Now I'm spending $2,000. It's going out. So I got to credit $2,000 in cash. I'm paying dividends. Dividends is going against my income, right? So it's going to be a debit instead of a credit. So I'm debiting $2,000. So you see how each time we have a transaction, it's debit, credit, debit, credit. And so everything's in balance. G, received $2,500 cash as partial payment for the legal work completed for client in E. All right, so they're paying me some money. They're giving me $2,500. So I'm collecting $2,500 cash. That means I have to do a debit. And they're paying me for some of the work. So I have a receivable on the books that I'm going to collect from them in the future. I have to reduce that. So I'm reducing my accounts receivable, which is an asset account, so I have to credit to reduce it. H says paid $2,500 cash for the legal secretary salary. Again, I'm spending $2,500. So that is my cash going out to credit. And it's for an expense because I'm paying my secretary a salary. So now I have salaries expense, which is a debit, $2,500. Okay, so I've put all my numbers into the accounts. And now I want to go ahead and add them up and figure out what the balance is in each one of those accounts. So cash, we had 15,000 plus 1,500 plus 2,500. And then I'm gonna deduct 3,500, 2,000 and 2,500. So my cash balance is $11,000 debit. So I'm gonna have it on the debit side. Equipment, 7,500 debit. My dividends, $2,000. Accounts receivable, I'm gonna take the 4,000 less the 2,500 to come up with my balance in the account, and it's gonna be a debit because it's higher on the debit side. So I have a $1,500 balance. On my liability side, I owed 7,500, but I have to reduce it because I paid some of that. I paid 3,500. So now my liability is $4,000 and it's a credit. I have my legal fees to credit of 5,500. Law library debit 6,000. Common stock is a credit of 21,000. And my salaries expense is 2,500. So now when I go ahead and do my trial balance, what would that look like? I need to just take all of these accounts and I only want the balances. Okay, so I have Sunny Law Firm. So that's going to be the name of this report. Sunny Law Firm is going to go at the top for the name. And then I'm going to say that it's my trial balance. I'm going to put a date. I think it's November. So it's saying November 30th. So we want to know what it is at November 30th. Whatever the year is. Okay, so we're going to just list out our accounts, and usually we start with the assets first and then go from there. So we're going to have cash. We're just pulling the balance, which was 11,000. It's going to go, remember you have two separate columns. This is your debit column. This is your credit column. You don't have to write it on there. Just give me two separate accounts if you have to do this problem. All right, office equipment, we have accounts receivable. I'm gonna put accounts receivable next. And that is 1,500. We have the law library. 6,000. The office equipment. It was 7,500. Okay, then we have liability, which is accounts payable. Accounts payable is 4,000. Okay, then we have our common stock. For 21,000. Dividends. 2,000. Legal fees earned. That's 5,500. Salaries expense. 2,500. Okay, that's all the accounts. Now I need to total both sides and see if they balance. If they don't balance, then we have something that's incorrect. We'll have to try to find the error. Okay, so we have 11,000 plus 1,500 plus 6,000, 7,500, 2,000 and 2,500. So my total is 30,500 on this side. And then my credits, 21 and 4 plus the 5,500. 30,500. Okay. So I went through all my little transactions that happened, put the amounts in under the T account so I can keep a log of what was happening in each of the accounts. And then I totaled them up. Once you have the total, then you can just list them out and put debit and credit and list them, and they should be the same on both sides. So if they don't match, if they don't add up, then something's wrong. You have to look to see, did you use the right amount? Make sure your math is correct. And then if all of that's correct, I would look and make sure that for each transaction, you have a debit and a credit. So this is a lot of work, but this is a good exercise to practice to know what's going on. So if I ask you to do something similar to this or a piece of this, you'll know how to do it. Okay, do y'all have any questions?